Hi there, everyone, and welcome to this month's edition of On Track. It's early morning on the 28th of February, the shortest month of the year. When I get this to you, hope everyone's had a great summer. Certainly a beautiful day on the beach this morning. Let's get into it. So firstly, this podcast is for clients of McGregor Wealth Management. So for anyone else tuning in, feel free to enjoy it, but please get advice that's specific to your own circumstances. What I'm going to cover today, all the usual stuff, the latest economic news, and it's pretty much interest rates, and inflation. It's pretty much all the market wants to focus on. That's what's keeping the market up. Going to have a look at how that's impacting share markets, property markets, but I want to revisit the basics or the fundamentals and how they shine through choppy times, and as usual, put everything into perspective. So let's have a look at the news. And as I said, share markets are looking for direction on inflation. In Australia, we only release our inflationary numbers quarterly, so still showing 7.8%. The US is dropping slowly, down to about 6.4%, but leading indicators are probably at 3 or 4, and I'll show you some of those. So it kind of looks like we're heading in the right direction. RBA raised their cash rate again, another 0.25% up to 3.35%. So that's starting to hurt mortgage holders a little bit more. In the States, their cash rate is 4.75%, which is higher. But you've got to remember, in America, most mortgage holders have fixed rate mortgages. So lots of them will be on lower rates taken out during the stimulus period. So those interest rates are doing their job. They're hurting. They're actually designed to hurt. So this is hard for people to understand sometimes, but the Reserve Bank is trying to slow inflation down by slowing the economy down. Now, they started this back last year, and we've seen, and I'll show you the path of this in a minute, but these interest rates, they don't know how many they need to do to get the desired effect, and they can't see the result of it till after the event. So it's a bit of an art form. They're copying a bit of negative press at the moment because it's hurting people, but it is the nature of the beast. And we are seeing some of these leading indicators slow down inflation, but all of a sudden, the cheapest mortgage rates have got a 5 in front of it. There's one special out there with 4.74. Most variable rates with the big banks are high 5s, and you'll see some 6s. As always, very important to refinance or renegotiate during these choppy times. The good news for retirees and those with cash in the bank is term deposits up to about 4.25%. We haven't seen rates like that for a long time. So all of a sudden, term deposits paying a decent return. If we look at the big four banks' cash rate forecast, so this is from the economists on the big four banks. CBA are the most positive. They believe 2 more rates by April 23, and then starting to drop. And by December 23, that's the end of this year, down to 2.85. Westpac, the complete opposite, up to 4.1, and they're dropping to 2.35, but by December 25. And NAB and ANZ have it sort of rising to 4.1 as well by May, but then dropping to May 24 and November 24, respectively. Now, the interesting thing is they all view that going up a bit more, and they all view it coming back. What they disagree on is the timing. So for share markets and for us as investors, it's important to look as far ahead as we can. And ultimately, we know here that they will get it under control. We don't know how much damage they'll do to the economy in the meantime, but we do know they'll get it under control, and they nearly always overshoot, which will lead to falling interest rate rises. So if interest rates fall back into that 2% range, even the low 3s, we'll probably see mortgages settle long term around about the 4.5% to 5.5% bracket. So that's certainly something to keep in mind when you're talking about fixing, and we'll talk more about that as we go through. Let's have a look at the CARE returns. This is to January 31st, so the end of the month for January. And we can see if we look down the 7-year column, almost bang on our long-term expectations. The high growth portfolio at about 8.67, the growth at 8.1, balance at 7.32. The balanced long-term has delivered the indices about inflation plus 5, so delivering there pretty comfortably. The 5 years is a fraction lower, with almost no inflation over that period, though. It's still pretty close to the long-term averages. And obviously the 3-year and 1 year starts to get into COVID and some of the other choppiness we've had. But very important to look beyond the short term to the long run. And we do expect investors to benefit from those long-term returns. Let's have a look and talk about lead versus lag indicators. So a leading indicator is something you look at to see what's going to happen next, whereas a lagging indicator is telling you what's happened. So a lag indicator is looking in the rear vision mirror, and the lead indicators are trying to look like a crystal ball. So down the bottom there, the headline from CNBC, Australian inflation hits a post-1990 peak. That's very much a lag indicator. So by the time you're reading the headlines, that's old news. And we'll talk about the news cycle again. Top left-hand corner here from the very good economists at AMP is their pipeline inflation indicator. And the black line here is the information they put together from all sorts of things, including commodity prices. That's been a pretty good predictor of where inflation's going. And you can see it's fallen off the cliff and heading back down towards 2%. So that gives us some confidence that inflation was probably heading that way as well. There's no guarantees in the economy, as I've said many times. And the Australian pipeline inflation, that's the US rate on the left, and the Australian one on the right, which is similar, is also dropping down to about 1%. So we're seeing that come down. That's a good sign of where the inflation number will go. And yeah, hoping that's spot on the money, because it would be nice to get some stable environments. One of the ways that the Reserve Bank is trying to slow the economy down, well, the main way is by pushing up interest rates. That will lead to a slower economy, and that comes through in unemployment. But one of the things that the market has been very mindful of is whether this inflationary episode finds its way into wage rises. So if wage rises start to get entrenched in the system like they did in the 70s and 80s, and that was when inflation went up 10%, wages went up 10%, and it was stuck in the cycle till Bob Hawke broke that with the wages accord. So the markets are keenly watching to see whether that happens again. And so far, there's no sign of that. So this shows that the wages change, and it's up to about just over 3%, which is palatable. And keep in mind, inflation at 6 or 7%. So there's good news and bad news on this. There's good news collectively, because it means we're not seeing a wages breakout. It's bad news for people that earn wages, because they've seen their cost of living go up 7%, but their wages only go up 3%. But it's almost like the collective good, because we do want that to keep in that sort of range. And part of the reason it's done that, part of the reason we haven't seen a blowout in wages, is because we've had what we call a supply response. So on the left-hand side here is the percentage of people that are underutilized in the employment markets in both Australia and the US. So it's not unemployment, but it also includes underemployment. So these are people that might be taking a sabbatical, or they're not working as many days as they could. So in COVID in Australia and the US, it peaked dramatically. So underutilization popped up to 22%. What we've seen in this last year is those people come back into the workforce. So while unemployment has only gone up a fraction, underemployment has come way down, and that's brought more people into the workforce, which has put more competitive pressure on, which means the shortages that we were worried about a year ago haven't translated into wage rises. So good news for the long-term economy. The behavioural bias I want to touch on this month is confirmation bias, and it's probably the most evil and insidious of all the behavioural biases. So confirmation bias is just where we look for data that supports our argument. And while that might seem, well, it's definitely logical, because that's what we all do. So if we believe that something's going to happen, let's say we believe the market's overvalued, we just go searching for information that confirms that. Now, where that's really dangerous is because it ignores other opinions, other facts, other data that might be contrary to that. We as an investment committee are extremely mindful of confirmation bias. We make a game of calling ourselves out on it, and we've almost got to argue the other person's point of view from time to time to make sure we get a balanced view of the world. Now, confirmation bias and all the other behavioral biases lead to this behavior gap, as identified by Carl Richards, but more appropriately by the Dalbar study that's been going on literally for 30 years now, that shows that the average return that investors get, which is the orange line, is way, way lower than the average return that their investments get, and the massive difference that makes over the long run. And that's 100,000 invested, and you can see the difference there. Investors routinely get 3 to 4% below what their investments would get if they just left them alone. And I'll talk more about those basics in a minute. But an update on that 20-year chart and the wall of worry model. And I'll dive in a bit deeper. Yeah, we talk about FOMO. The last boom we had, and a boom is FOMO, was back from 2004 to 2007. My definition of a boom is where the market's doubled in the previous 2 to 5 years. And if you look at the market almost getting to 7,000 there, 6,800 it was, you go back to 3, 4, and that was in about 2000 and early 2005. So in 2.5 years, the market doubled. And that's a definition of a boom. That's why we need to be very, very careful, because a boom is inevitably followed by a bust. This was one of the biggest busts in history, and that's a hello from my dog, Bodie, in the background. So that was one of the biggest busts in history, 50%, always followed by a rebound. So if you go back, and if you go back just 1 year before that bust, the market was at 5,000. And if you go back to 3 to 6 months after that bust, the market was at 5,000. So from 5,000 to 5,000, not much damage. So the damage is done at the frothy bit of FOMO. And that's where we've got to be super careful. We're nowhere near that at the moment. The time to double for the market at the moment, for the Aussie market, it's been 9 years. So well outside that 2 to 5 year range. And then that means we're quite firmly in what we call the wall of worry. And the wall of worry is just where the market wanders up the hill, so to speak, but with lots of periods of downturns where we're worried about something. And the latest bout of that with the fear or the worry of inflation. And we're seeing that slowly filled in. And that eventually will lead to the market climbing up higher again. And eventually another worry will come along. Let's have a look at the yield curve, which I've been showing for the last little while, because it is an important indicator on two things. It's where long-term rates are, and it's where the market actually thinks inflation's heading. If the bond markets thought inflation was going to roar a rate of 7, 8, 9, 10%, that's what long-term bonds would be, because people want to demand a fair return on their investment, allowing for inflation. Long-term bonds in the US and Australia, so the charts down the bottom, show both in the high threes, 3.9% in Australia, 3.9% in the US, and it looks like it's starting to steady. So that's telling us, and normally the bond rate is going to be 1 to 2% above inflation. So that's telling us the bond market has confidence that this battle is won. Time will tell. There's no guarantees. We've seen an upward shift in the short-term interest rates in Australia. So 1 year bonds up around nearly 4%. And that's just a reflection of the cash rate of where the RB's taken it. And this orange line of 6 months ago, you can see how far we've come. And I'll show you some more data on the trajectory of rates in a minute. But yeah, short-term rates up from 2s to 4s, and that's coming through in mortgage rates. The good news, bad news cycle, and I've talked a lot lately about how for news to affect the market, it has to be surprising, and it has to be, so it has to be new news and surprising. If the news is just a repeat of what we know, it doesn't impact the market. The things that are keeping the market up at the moment are things like inflation, how long it's going to run, interest rates, how high. There's an expectation that as the economy slows this year, profit growth from companies all around the world will slow as well. So the big question is, how far will they dip? If they just slow a little, the market's kind of got that taken into account. So even though you'll see headlines later in the year, the profits slump, you may find the thing that the markets go up because they're looking over the hill to the next lot of profits, which will be anticipating low interest rates. And this can be super confusing for some people because they think, oh, there's bad news, the market should go down. But the market is looking forward, and it's always looking forward to that. What's coming up next? So if it's anticipated bad news, sometimes you get this thing where the news is less bad, and the markets actually go up because it was less bad, excuse the grammar. So some of the other things on the market watch list is Russia, Ukraine, but the war grinding out for a long time is pretty much what's baked into the market at the moment. So if there was any positive outcome, that would be good news to the market and relatively unexpected. as would any catastrophic escalation, nuclear weapons, something like that. Highly unlikely, but it would represent bad news. China's a wild card on all this stuff, and they gravitate from playing nice to not playing nice, and that depending on what's expected. But we kind of don't expect them to play that nice, so that's kind of in the market. There's a lot going to go on in US politics this year. With the houses divided, that just means the government can't necessarily get their legislation through, and we'll see that come through in what's called the fiscal cliff. The US imposed, in their wisdom, a debt ceiling on how much the government could borrow. Sounds like a good idea, but with inflation and wages going up, it has to be increased all the time. So you'll see games later on this year. So expect to see newses that the US government's going broke and that they're not going to be able to pay wages. It's all headlines. It's all, and they may force some almost shutdowns for a couple of days or a week, but at the end of the day, the Republicans in opposition will support that, but expect that. So it won't be unexpected news. And the other ones I've got in there is extremism. The noisy minorities on every debate dominating, while the silent middle grind their teeth and wish we could have good debates. And the media's tendency to catastrophize everything. Let me jump through now. In terms of our market context, we have the market quite firmly at fair value at the moment. So it's pulled back a little, which I'll show you in a minute. And so, on the dial, fair value. So we think there's very little chance of major corrections. You can never say never. COVID proved that. But from fair value, there's very small chance of a downturn of more than 20%. In any one year, there's always potential for downturns of 5 to 10%. But that's completely normal. But the big ones are what we're trying to avoid. So in our messed up equation, I'll talk a little bit today about two that are kind of not talked about enough, but illiquidity. The three ways people lose money from the market. One is panicking and selling when the market's down. The other is having to sell when the market's down. And if you're in a broad balanced fund and you're in pension mode, it's a balanced fund as a mix of shares and bonds. And if that's all you've got and you're pulling money out every month, when the market's down, you're selling shares. Using our reserves process, in our care process, the money that comes out for our retired clients' pension payments comes out of the reserves. So our clients never have to sell at a bad time. So that means they get to enjoy the long-term benefits without any of the short-term pain. And that's a critical part of our process. So the other one, and that means you've got to be able to sell, by the way, you've got to have liquid investments. And so that's an important part of our process. And the other is beautiful, boring diversification, which the definition I've used, which I borrowed from a guru in the States by the name of Nick Murray, but his definition of diversification is where you bargain away the right to make a killing in return for never being killed. A fair trade-off, and one that we happily make every day for our clients. I want to pause briefly because I'm going to show you some results of the care process over the last 7 years. We're fast approaching 10 years. We'll have 10 years worth of numbers, but we only show up on the 7-year tables at the moment. But the one that I've circled there is modern portfolio theory, which is all the boring technical stuff that doesn't really excite anyone. It's having the right asset allocation, the right level of diversification, rebalancing the portfolio on a reasonably regular basis, and getting exposure to the right assets at a cheap rate. Now, we've done that, and we've done that fairly boringly. We have a catchphrase, exciting life, boring money. But look what it's done. When we look at the Lonsec survey, which we insert ourselves in, our growth fund, our core growth fund, over the last 7 years sits at the top of the table. So number one over 7 years. Over 6 months, ironically, it's number two. And I'll talk a bit about why there. But you got other funds that are top of the table for 7 years and well down the bottom for 6 months or 1 year. Well, we've managed to strike that balance with that technical structure of the portfolio, but keeping it boring, low cost, etc. So our growth fund is 80% growth. So it sits at the top of that 60 to 80% band. And our care balance, which includes the other bits of care, sits comfortably in the top quartile. Now, the difference that makes, our goal has always been to be above average. So that's second quartile or better over the long run, and above average in performance, below average in fees, two things we tick comfortably. If you look over 7 years down the bottom here, The average fund was about 6.64. So our core fund there was about 8.08, and the care total 7.3. So well and truly, 1 to 1% above the average. But look at the worst. So the worst over that period, 4.64. And it came from one of the biggest fund managers in Australia, IOOF Wealth Balance Fund. So lots of the big names, the old banks and other things, sit at the bottom of the ladder. And it's due to their lack of nimbleness and other complacency factors and often higher fees as well. So because we sit below average fees and we access investments cost effectively, that's helped that long-term performance. So quite satisfying. We don't rest on our laurels on that. It's a tough game. So our aim is to continue that, and something we've done, and I'll show you one example shortly. So let's have a look at the markets, and you'll see the Aussie market really strong in January. So January numbers, and I've got the performance tables up here on the left. So January, the Aussie market was up 11.6%. Now, at that point last month when we were speaking, we said that's probably just a bit overvalued, and the market's retreated a little bit. And it looks like it's finding an uptrend. We'll see whether it drops some more or whether we start to move up. We kind of expect that at some point when the market accepts that the battle against inflation is won and that interest rates will probably return to a lower level, the value will go up, and then we'll be more focused on the profits and all the other things that affect long-term valuations. Look, it's always good to look at the long-term compounding. $10,000 invested 10 years ago in the Australian market with money reinvested is worth about $25,000 these days. So long-term, fantastic. Bottom left-hand corner shows the wonderful companies that we get access to for less than 0.1%. So that low fees, within VAS, which is where we get access, BHP, Commonwealth Bank, CSL, obviously the top 10 companies in Australia that we get for next to nothing. US shares, or in this case, IOO, it's actually the top 100 companies in the world, but you can see it's dominated by US companies like Apple, Microsoft, Amazon, etc. And this is fascinating. And let me talk about the bottom right first. But yeah, $10,000 invested in IOO 10 years ago is now worth $40,000 in Australia. So it starts to sound like, wow, that's gone up a lot. Is that in FOMO, Rob? We have it at fair value, and the top left-hand corner explains why. So if you are a US investor, this shows the same chart as the bottom right, but for US investors in US dollars, they've had, remember I said the Aussie market up to 25,000? So almost the same over there. So that would be a double in 9 years, which is very, so the difference between those two is currency. The Aussie dollar dropped from about $1 10 years ago to about 67 cents as we speak. So that difference in return, so we as Aussie investors have made an extra 13,000 for every 10,000 on our US/international shares, to say it roughly. Now, we recognize that the currency is so important for international shares. So we took some action, and the chart on the left here shows the Aussie dollar for the last year, and we'll see it dropped. There was a period in October where the Aussie dollar dropped to 62 cents. Now in our active portfolio, we were nimble enough to say, wow, this is a bit out of character. It's probably short term. We didn't know that for sure. No one ever knows that for sure, but let's hedge our international shares. So we switch from IOO, which is unhedged, to IHOO, exactly the same companies, but now hedged to the US dollars. And you can see in the right-hand chart the difference that's made. So in the time since October, when we did that, we're running at about 6.5% ahead of what would have happened if we hadn't left that. So it's only one small element of the portfolio, but that extra 6%, even for 5% of the portfolio, translates to 0.3, 0.4% on the return. So it helps pay for our process and deliver strong returns that will keep us there. Now, we've got to keep making those decisions. We don't make lots of those. Our whole philosophy rests around having a really good structure that we don't mess with too much. But when there's aberrations in the market over the long run, some little changes can make a big difference, plus the rebalancing that we do. US small caps, same story, spectacular over the last 10 years, 10,000 to 42,000. In the last year, they're also up strongly, not as strongly as the Aussie market, up about 5.4%, 15% in the long run. So this top left-hand corner is something that forms part of our investment committee report. So the highlighted orange shows that IOO that we were just looking at, and IGR that we're looking at, have run 15% performance over that, 14 to 15% over the last 10 years. So it sounds like that could be excessive, but it's all the US dollars. And you can see down here, 10 years ago, the Aussie US was on parity, $1.05, slightly above, and right at the moment, we're about 68 cents. So yeah, that's responsible for that. We measure the time it takes for a market to double with reinvesting. And even though this one, IJR, US small caps, and IOO, global large caps, are in that 5 to 6 year range, if you take out the currency, they're actually in the 9 to 10 year range. So that's partly why we have fair value on everything, because we're definitely not in a crazy bull market. We'll have all sorts of volatility, which we would expect, and going forward, in every year except for one in the last 35 years, the market's had a 5 to 10% downturn during the year. So that's normal and to be expected. Last year, we had 3 of them. And you can see those 3 dips along the way. Now, this year, maybe we will, maybe we won't, but it just matters about that long-term direction. Emerging markets, we still have as very cheap. So compared to the others, $10,000 invested 10 years ago, only worth about 17 to 19,000. And emerging markets is things like Russia, China, Brazil, and they've had a tough time in the COVID era. They look extremely cheap, and they include some amazing companies like Samsung, Alibaba, Taiwan Semiconductors that makes chips. There's a lot of Chinese companies in there. They've been subject to some instability as the government gets more active and some of the CEOs disappear off the face of the earth. So that gives the markets less confidence. And that's why we hope China becomes more transparent. Whether that does or doesn't, we will see, but that's factored into the price. And we think emerging markets are good value. Gold is another one that's normally, if the markets were expecting runaway inflation, gold would take off. We haven't seen that. Gold's been solid. In the last 10 years, gold's averaged about 5%, so better than cash. But it's certainly not spectacular. In the last year, while we've had all these inflationary worries, gold's only gone up about 6.6%. And keep in mind, the price of holding gold is we don't get any income. We also switched some of our gold holdings to hedge. So we've actually made more money in the last 4 months than this chart shows, because we locked in the currency for gold for part of the portfolio as well. Sorry, and I'll just go back up. Our property, let's talk about property in our overall. We rely on 2 frameworks when we're sort of working out where property's at. One is the property clock, which just shows that property goes through a predictable process of rises and falls as different things happen, like interest rates, etc. And in the long run, it goes up. It goes through long periods of not doing much, followed by rapid periods of going up. We've just been through one of those rapid periods in most of Australia. It kind of looks like this, and it's all driven by interest rates. So let me use this chart to explain. The interest rates started, we saw the drop in COVID, March 2020, which was the bottom of the financial markets, massive response by the governments, and they were already had low interest rates, and people forget interest rates were low when we went into COVID because the Reserve Bank was trying to keep it low to stimulate growth. We had a low growth world, so they dropped rates even more. So we had rates reach that bottom of about 0.5% in 2021. So from the start of COVID to that bottom of the interest rates, we saw 26% uplift in property prices on average around Australia from September 20 through April 22. And then we've come back 8.6% as interest rates have gone up that steep cliff. And you can see the property price decline started right when we expected interest rates to start going up. And it's been quite subdued. And you can do the maths, but if you go up 26%, then you come down 8, you're still doing very well over that last period. So since COVID started, we're all sitting well above our property prices. And property prices have been resilient. The next phase, at the moment, it's looking like stabilization. If interest rates went up dramatically, it could be more weakness. But if interest rates start to stabilize, we could actually see a rebound. I don't think it'll be a rapid rebound, but who knows? And we'll see what happens. I repeat those forecasts there from the big 4 banks. I don't hold much credence in those. Economists are lousy forecasters. It sounds terrible, but they've got a terrible track record of forecasting, and they'll change as the conditions change, and we'll see where it goes. Now, there's maybe confirmation bias. but I'm probably in the corner of CBA. And I think we might start to see rises, maybe not, sorry, falls, maybe not by December 23, but talk about maybe, you know, in the first 6 months of 24, we may see some falls there. But either way, I agree with the overall consensus that by the end of 24, you would expect to see lower interest rates. But this is so hard to predict. So this chart down the bottom just shows all the different, you know, median values. So Sydney, you know, just slightly below $1 million. It was over $1 million. It's down about 13.8% over the last 12 months. But as I said, it had gone up massively. Melbourne at $750,000, Brisbane at 700,000, Adelaide at 646, Perth at 560. We do think Perth probably represents the best value for investors looking to buy investment properties at the moment. And I'll talk more about that. And once again, this gives more information on that peak to trough growth. And you can see, you know, ACT up 38%, Adelaide up 44%, Brisbane 42%. So from that COVID through to the peak, massive increases, and regional Australia even more so, nearly up 40% across the board in regional Australia. So combined regionals 41.6%. And sorry, my mouse is running away today. Yeah, and then the drop across Australia, so up 28, down 9%. And you'll see here, rents are giving some relief to property owners. Rents up, you know, 10% on houses, 12% on units, so 10% overall, 9% on houses. Yeah, well, CPI up 2.8% over that period of CPI rents. So yeah, solid base looking like on the property market. So I think it's going to stabilise, but it will very much depend on where interest rates get to. I like this little chart from Domain that came out of a newsletter that I subscribe to. You know, we tend to see negatives bigger than positives, but when you look at the Aussie market going back to 1995, you'll see each swing, and, you know, up 44%, down 1.7, up 76%, down 0.5, up 30%, down 4.7, and so on. And that's the reality of the market. The downturns are relatively minor. This current downturn is looking like a record. Now, these are calendar years, and so the numbers aren't showing the full extent of that 9% downturn, but this one's looking like a record. But because it was off the back of such strong growth, it's reasonably palatable. There'll be a small group of investors who bought, you know, say 12 to 18 months ago, right at the peak, who are copping it from high interest rates. So there may be some, you know, some forced sales, but it's such a very small part of the overall market. It's not having a major impact. The decision to fix rates or not fix rates, I've changed the headline this month. I had avoid fixing. Now that the rates are getting up, so the variable rate, and you see the table I've inserted here, variable rates on, these are the averages, about 5.71. So that variable rate is now lower. So if you look at the 1 year rate, sorry, the 1 year rate is slightly lower. So in theory, locking in a 1 year rate will get a better rate than the variable rate. You've got to look at each bank individually, and you've got to assume that the banks aren't silly. So they're probably assuming rates are going to drop a bit in the next 12 months. You'll see the 2 year rate is pretty similar to the variable rate. So yeah, they're not sure. There's nearly always a premium for locking in longer term rates. So 5 year rate at the moment at 6.44. Now there's two reasons that people fix rates. One is certainty and insurance. So just to know what you're getting. So for people that absolutely want to know what they're going to be paying for the next 1, 2, 3, 4, or 5 years, fixing rate can be a good thing to do. And the other is predictive, and predicting interest rates is one of the hardest things that there is. I've watched over 40 years, the almost impossibility of predicting rates in the short to medium term. So yeah, very much look at your own circumstances. I'd still erring on not fixing at the moment, but it very much depends on own circumstances and the need for certainty. So our friends at Performance Property, who we use to search for property for clients looking for investment properties, still have a cluster of value areas in Australia, predominantly country Queensland, places like Mackay, Rocky, Cairns, and Toowoomba. My preference out of all those is Toowoomba. It's closer to the capital cities. The further away you get from a capital city, the more risky a property is, just in local economic cycles. And out of the capital cities, Perth still shows up as the best value. So there's plenty of areas to get value. And in those areas, rental returns are higher relative to price. So that makes the paying for the property easier. And yeah, we're often looking to get a result in the first 5 years of someone's investment property. There's nothing worse than having to wait 10 years till you get a result. And the stats show that lots of people sell out their properties because of dissatisfaction with performance, because they often buy during a boom and sell after that stagnation. So be careful on the property front. There's still areas that represent value and that were suitable for many people planning their accumulation. For others at the retirement end, taking profits at the top of the cycle can be a good thing to do, because otherwise you're strapping in for the next cycle, which could be anywhere from 8 to 20 years. So where you may not see a lot of growth, and you might too. So it's always hard to tell. But yeah, certainly individually assess where you're at as part of your plan, which we will help you with. So wrapping up again, our exciting life, boring money process. We get back to our principles and values that we invest in, and that is all investing is best done as a real plan, which is personal to you, your goals, your life. So designed to give the right amount of money to you over the long run with your estate planning goals. We design the portfolio to meet that way absolutely long term. Those boring principles I talked about: diversification, asset allocation, liquidity, bought at a low cost, rebalance regularly, has delivered these strong returns over the last 7 years. And low cost makes a massive difference. We protect against the short-term volatility through reserves for our retired clients, and dollar cost averaging for our clients that are still building wealth, and that makes a massive difference. And boring stuff again, rebalance regularly. And finishing on those 3 ways to lose money: panic and sell, having to sell, not properly diversified. Our clients don't do that. Congratulations. And part of that's the persistence of the conversations we have. And we also appreciate the trust you have in us in guiding you through that journey. Thanks again for listening. If you got this far, I'll be talking to you next month. And in the meantime, have a great day today and the rest of the month. And let's hope we get some great news. Rob McGregor signing out.